Your phone buzzes at the kitchen table. One word lights up the screen. Approved. For about 3 seconds, your shoulders drop. The listing photo on the laptop looks warmer. The cold coffee becomes celebration coffee, which is mostly just cold coffee with confidence. Then the little word starts asking for rent. Approved sounds like a finish line, but it really means the numbers cleared one test. It doesn't mean the house has already made room for repairs, savings, future you, or the month where everything breaks at once. So you picture the keys, the front door, and the little speech where everyone says, "Finally, you made it." Then future you sits down across the table without asking. Same face, worse posture. Future you slides over a second stack of bills and taps the phone. The approval is real. That is what makes it dangerous. The question is not whether the bank said yes. The question is what that yes did not answer after the happy screen goes dark. Next, the house stops being a photo and becomes a price. Now you are on the front walkway. There is a for sale sign, a fresh welcome mat, and someone has already hinted it could be your place, which is legally not a spell, but emotionally very close. Inside, the pressure is social before it is mathematical. The house is not a mansion. Normal living room, normal kitchen, normal corner where you imagine putting a plant you will definitely forget to water. Because it looks ordinary, everyone treats the decision like it should feel ordinary too. But the price tag is not imaginary. AP reported that NAR put the U.S. median existing home sales price at $429,300 in May 2026, the highest median price for any May in data going back to 1999. Sales also rose that month while inventory stayed below historical norms. So waiting can feel expensive, signing can feel urgent, and the house gets to stand there looking harmless while the price tag quietly practices its villain smile. Your exact payment could be different, but now the lender is about to turn this normal-looking house into one official monthly number. At the bank desk, the giant price tag gets chopped into pieces. 10% down is $42,930. The loan becomes $386,370. On the video call screen, the folder looks calm, which is rude behavior from a folder. Then the paper does the thing paper does best. It makes a huge decision look tidy. Use a 30-year fixed mortgage at 6.49%. The average Freddie Mac showed for June 25, 2026. And principal and interest lands around $2,440 a month. This is example math, not a mortgage quote. Now, the $429,300 house stops acting like a mountain and starts acting like a bill. A monthly bill feels negotiable. It fits on one line. It lets the approval stamp sound like a plan instead of a warning. But $2,440 is only principal and interest. Before taxes, insurance, HOA, maintenance, utilities, repairs, and other life costs. The pen hovers because possible on paper is not the same as spacious in real life. Next, that payment meets your actual paycheck. Back at the same kitchen table, the official number meets your actual month. You write $9,000 gross income on one paper, then slide $2,440 beside it for principal and interest. For a second, the stack does not look impossible. There is a reason lenders care about this kind of math. Debt to income compares monthly debt payments with gross monthly income, and lenders use it as one way to judge whether a borrower can manage monthly payments. In this example, $2,440 is about 27% of $9,000 gross. Then real life starts touching the piles. The grocery receipt leans in. The car key coughs. The retirement app does that fake calm thing apps do when they know you are about to ignore them. That 27% is before other debts, paycheck taxes, groceries, transportation, childcare, savings, and the goals that made you want stability in the first place. The approval can say the payment passed a test. It cannot prove the house leaves room for your life. Next, the costs outside principal and interest pull up chairs. Then, the second payment walks in. It is not one bill, which would be too honest. It is a little committee. Property taxes pull out a chair. Insurance sits down without asking. HOA fees, if they apply, bring a clipboard. Utilities wave from the hallway. Maintenance and repairs arrive late, because of course they do. This is the part buyers feel after the approval glow fades. Business Insider listed taxes, insurance, homeowners association fees, utilities, maintenance, and repairs as the often overlooked ownership costs that can make the monthly picture much heavier. One-sided Minneapolis Fed analysis found typical mortgage holders put about 40% of monthly housing payments toward non-mortgage expenses in 2023, up from about 38.5% in 2021. Now your approval night smile has company. The $2,440 principal and interest number is still real, but it is not the whole dinner bill. Some costs are estimated up front, some change. Some show up when they feel like being dramatic. So the chair you need to watch is the empty one. Now the hallway between the house door and your paycheck gets a new roommate. The full stress test bill. The $2,440 number is still there, but it stops being a loan. If that principal and interest payment is treated as roughly 60% of the housing payment, the stress test total lands near $4,070 a month, with about $1,630 outside principal and interest. Suddenly, the house is not standing in the doorway. It is standing in the doorway, holding a chair, a ladder, and a bill for the ladder. On $9,000 in gross monthly income, the clean number was about 27%. This version is about 45%. Before other debts, paycheck taxes, groceries, transportation, childcare, savings, and other goals. The grocery bag gets smaller. The retirement jar politely moonwalks backward. Your actual costs could be lower, they could be higher. So the stress test is not trying to predict the exact bruise. It is trying to see whether the budget has skin. Month 3 is when the house develops a personality. Not a charming one. A ceiling drip starts in the bathroom, and suddenly you are holding a wet towel like it came with the welcome basket. Another drip lands, then another. The calendar still says Normal Tuesday, which feels rude. The repair quote joins the counter stack because repairs are one of those ownership costs that can sit outside the clean principal and interest number. Taxes, insurance, HOA fees, utilities, maintenance, and repairs do not care that the approval letter looked confident. The approval letter cannot mop the floor. Debt to income can help a lender judge monthly payment ability, but it is not the same as proving your groceries, car, savings, sleep, and one wet ceiling all fit. Maybe this repair is small, maybe it is not. Either way, the month was already crowded, and the house just found the weakest part of the room. By month 4, the loud bills have found rhythm. The mortgage wants its part, insurance hums, utilities tap the microphone. Last month's repair quote is still standing in the doorway. You are in bed under the lamp, work shoes on the floor, unopened mail doing its tiny paper guilt routine. Then, the quiet bill appears on your phone, the automatic investing transfer. In this example, it is $300 a month that used to leave before you could negotiate with it. Now the app offers one beautiful, terrible button. Pause. That is how savings can lose first. It is polite. It does not leak through the ceiling, charge a late fee, or threaten the lights. It just lets future you absorb the damage quietly. Maybe pausing for 1 month helps. Maybe it becomes the new normal. The approval never measured that trade-off with your goals. Next, the outside world sees the house and claps. Behind the door, the payment is still voting on your future. Month 6 is confusing because the house works socially. Friends come over, paper plates sag, and someone says, "The place looks great." They mean it. You feel proud, because of course you do. A home can mean stability, privacy, a yard, a plan, and fewer midnight performances from the upstairs neighbor furniture bowling league. After everyone leaves, the house gets quieter and the math gets louder. The porch got compliments. Your phone got another insurance notice. The fridge still holds the approval letter like a diploma. The drawer holds the $4,070 stress test note like evidence. That is the strange part of being house poor. From the street, it can look like you won. Inside, the payment gets a vote on dinner, savings, repairs, travel, and how often you say, "Not this month." Maybe your real costs are lower. Maybe they are higher. The uncertainty is exactly why the drawer matters. Next, the pen comes back into the story. Before the final signature, what would pausing actually protect? Now, rewind to the closing table, right before the pen touches paper. The pen is hovering, the folder is open, and one tiny cartoon bead of sweat is doing a full marathon down your face. One door says "Sign now." Behind it is applause, relief, and the clean number you already know, about $2,440 a month for principal and interest in this example. The other door says "Pause." Behind that one is a calendar, an old apartment key, and the larger stress test number, about $4,070 a month when the non-mortgage side of housing is treated as part of the payment. That pause feels embarrassing because signing feels like proof you made it. But a mortgage approval can clear an underwriting question without proving the house leaves room for repairs, savings, and the rest of your life. Maybe the 3-month test bends your budget, but doesn't break it. Maybe it cracks on week 2. Either answer is useful before keys are hostage. Next, keep the same house, same desire. 6 months later, the kitchen table looks boring in the best possible way. Same phone, same blue shirt, same desire for a home. But the emergency fund jar is fuller, the calendar has a repair fund mark, and the $4,070 stress test note is lying flat instead of towering over dinner. You treated the full housing number as if it might really show up, not as a rude ghost the approval letter forgot to invite. The payment got practice reps next to repairs, savings, and normal life, so the house had to compete for space before it got keys. Maybe you still buy, maybe you buy a different place, maybe you wait. None of those choices makes you a better or worse adult. The quiet win is that approval no longer gets to impersonate life affordability. Uncertainty stays on the table. Costs can vary, and waiting does not magically fix every market problem. But options are what money is supposed to buy, before it gets distracted by countertops. Next, future you turns this calmer table into the 3-line check before any signature. Before the signature, you clear the kitchen table and turn the approval into 3 lines. Line 1 is principal and interest, the clean number that made the yes feel possible. Line 2 is the rest of owning the place: taxes, insurance, association fees if they apply, utilities, maintenance, and repairs. Line 3 is 1 bad month, because life loves arriving without an appointment and somehow with tap shoes. This is where debt to income helps, but stops short. The CFPB defines it as monthly debt payments divided by gross monthly income, and lenders use it as one way to measure whether borrowers can manage monthly payments. Useful? Yes. A full life survival test, not by itself. So if the house only works when line 1 behaves, line 2 stays polite, and line 3 never knocks, you are not looking at comfort. You are looking at a budget holding its breath. Costs vary, and no checklist can predict every repair or bill spike. But before the final scene, future you points at the bottom. What would you refuse to sacrifice just to look approved? You are at the front door, keys in hand, thumb resting on the lock. Behind it is the version everyone can photograph: the room, the paint, the little proof that the approval text was real. But approval was never a full life permission slip. It can show you met an underwriting test. It does not prove the house leaves room for repairs, savings, groceries, transportation, and the next month that refuses to behave. In our stress test example, the payment that started as principal and interest became about $4,070 a month, once non-mortgage costs were treated as a major part of the housing bill. That number is not destiny for every buyer. It is the bill stack clearing its throat before you sign. So the safer question is not, can I get approved? It is, after the real payment, surprise costs, and 1 bad month, do I still have a life I would choose on purpose? If yes, turn the key. If not, pausing is not failure. Comment with one thing you would refuse to give up for the house, and subscribe to Stick Finance.